Welcome to Basic Trading Terminologies. This is the final installment of the introductory section. And here we're going to go over a few terms, a few keywords that you may have heard during the course of this training, or others which you hear whilst becoming a trader. All of these terminologies are not something that is difficult to learn or understand. And we do advise that it is better you know these than you don't know them. Why is because even during our training, we'll be saying some words which are relevant to trading and the financial markets. So it's important that you have an understanding, or at least a basic understanding, as to what these trading terminologies are. On top of that, if you are struggling, please remember you can re-watch this video. On top of that, we have a glossary on www.hmarkets.com where we have a full list and breakdown of all the trading terminologies. And then on top of that, I'm sure your account manager here at Handtech will be able to assist you best when it comes to understanding trading terminologies. Please have your pen and paper ready. We're now going to discuss some of the basic trading terminologies that you should know. So the first one we'll discuss today is Metatrader. Metatrader is something that you will hear quite frequently. Metatrader is in fact the platform that we use for trading, okay? And this Metatrader platform is very simple. It can be downloaded across 3 devices, one being your laptop, the other being your phone, and the other being a PC or a tablet. So here is where you find all your trading activities going to be held. You have access to the financial markets themselves. So this will be your FX pairs, your oil pairs. All instruments that are available to be traded will be available on the Metatrader platform. It comes in either Metatrader 4 or 5, but we rest assured that Handtech Markets has these available for you to use. It's imperative for you to understand that Metatrader is the only platform that Handtech has. And it's something that is used globally, not only just at Handtech, but across all different types of brokers. Another trading terminology that you'll hear quite frequently used here at Handtech Markets is client portal. Client portal is the management or the back end where you, the trader, have access to your platform, okay? There is no trading done here in Client Portal, but this is where you'll be able to deposit, withdraw, understand what your positions are, make use of any trading tools that we have like Trading Central, or become a partner if you're interested to become an IB. All of this is done within the Client Portal. Very simple. Just think of it as the back-end management for your trading. The next term that we will talk about, which is a little bit more technical, beyond Metatrader 4 and beyond Client Portal, is now PIP. Again, this is something that you'll hear. Some of us may have already heard this, but it's a very important term that we use in the world of trading, and it's got to do with where we move when trading, or the value that is moving when trading, which is directly related to your profit and your losses. And again, during this training, you'll understand a bit more about that. So on the slide, it says a PIP is short for percentage in point or price interest point. It represents a tiny measure of change in a currency pair in the Forex market. I use Euro USD as an example because it's the most popular traded product that there is available at the moment. And it's very simple to understand how pips move on Euro dollar. So in this example, we have if Euro USD moves from 1.1050 to 1.1051, that's a 0.001 USD rise in value. That is regarded as 1 pip, okay? Please make note of this. Most pairs go to 4 decimal places. So in the example that I've shown you above, if you notice, we have the pip movement from 1.1050 to 1.1051. You notice that this one is the 4th one after the decimal place. It's the 4th number after the decimal place. So that is where we regard 1 pip movement, okay? Please make note of that. It's something very important to learn in your trading. And again, as I've said, most pairs go out 4 decimal places, but pairs like Japanese yen, they go out on 2 decimal places. And I have an example which is a bit easier to understand in my next slide. So as you can see, Euro USD 1.1321. This green one is where we regard that 1 whole pip movement. So if this number 1 changes to, sorry. If this number 1 changes to 3, for example, that has now become a 2 pip movement, okay? So always regard this green number, the 4th number after the decimal point is that pip movement for Euro USD, GBP USD, most of the pairs. As you can see, USD JPY, the JPY pairs, they move on a different pip movement. USD JPY moves on the 2nd pip movement, okay? So we have 113.21. This green one is the 2nd value after the decimal place. That is the pip movement, okay? 113.21. So if we're looking at USD JPY and this one changes to, let's just say 4, that is a 3 pip movement, okay? So just always consider that for Japanese pairs, they move on the 2nd decimal place. Another trading terminology that we hear frequently, and that is used in brokers, you as a trader should really understand this concept because it really dictates which broker you go to for some people. You understand? And again, this is where we have this question asked quite frequently. How do brokers make their money? How do brokers make their money? Well, this is how they make their money. We have something called spread, okay? And this spread affects both the broker and the individual trader. And putting it very simply, all the spread is the difference between the buy and the sell price, bid and ask price. You notice that there are 2 numbers here, 1.1051, 1.1053. There is a difference of 2. As we can see, we mentioned it before, that Euro USD moves on the 4th decimal place, right? So this one and then this 3, there's a difference of 2. There's a 2 pip spread on Euro USD. So this is where the broker makes their charges. Every time you execute either a buy trade or a sell trade, you'll be charged that spread. And that spread there is 2 pips, okay? So that is the basis of spread. It's the difference between both prices. Bid, which is buy, ask, which is sell, okay? That difference is spread. Spread can be static. So for some brokers, they may have a fixed spread. So Euro USD will always have a spread of 2, for example. Other brokers have what we call variable spreads. And that is the difference between these 2 numbers, 1.1051 and 1.1053, will always be changing depending on market conditions. So if the market is volatile, for example, you will often see that brokers will widen their spread because there is a lot of activity going on in the market. There's a lot of volatility going on in the market. So brokers will widen that spread in order to make sure that the price is competitive across their platform. So we have variable spread. One day it can be 1.8, one day it can be 1.2, one day it can be 2. But these are things that will all be reflected in your trading platform. So take note of that, okay? So that is spread. The next terminology that you'll hear very frequently, and again, this is everyday trading. Whether you're basic, whether you're intermediary, whether you're an expert, you should understand or at least know what the concept of lot sizes are. If you don't, it might be very difficult for you to understand what it means to trade, okay? So currencies are traded in lots, which are batches of currency used to standardize the quantity for Forex traders. That is it in its very simplest form. One standard lot or a standard lot is 100,000 units of currency, okay? So if you trade one standard lot on your platform, that is equivalent to trading 100,000 of that currency. So if you trade Euro USD, okay, you trade one standard lot on Euro USD, that means your currency is dollar. You are trading $100,000 when you place that one trade, or equivalent to $100,000, should I say. There are smaller sizes available, which I know most of us as traders will understand. There are mini lots and micro lots. A mini lot is worth 10,000 respectively, and a micro lot is worth 1,000 units respectively. So when you're trading 0.01, which is a micro lot, that is equivalent to 1,000 of that currency. And when you're trading a mini lot, which is 10,000, that is equivalent to 10,000 of your currency, 0.1, okay? Again, continue so that it's a little bit easier for you guys to see. And I know most of us are either trading or beginning the trading journey. When you're in your platform, you'll see, how do I trade? You then click the trade button and it asks you to put in your size. So this is how it looks. One standard lot is equal to 100,000. 0.1 is equal to 10,000. 0.01 is equal to 1,000. So if I do 0.02, that is equivalent to 2,000 units. If I do 0.2, that's equivalent to 20,000. If I do 10 standard lots, if I do 10 standard lots, that's equivalent to 1 million units. I hope there are many traders out there that will be doing 10 standard lots with us here at Handtech Markets. But this should be a visual understanding of how lot sizes works. So here again, I'm talking about lot sizes. You notice that this section is relatively long. It's because lots are very important when it comes to trading. If you don't understand lots, then it's very difficult for you to understand the actual concept of trading. So here I have understanding a micro lot. A micro lot represents 1,000 units of any currency, okay? Similar to what I said previously. A 1 pip movement for a micro lot corresponds to a 10-cent change, okay? And the example that I use, please take notes, is if you buy 1,000 against Japanese yen at rate of 10900. So again, breaking it down, if you buy 1,000, so that is if you trade 0.01 against Japanese yen, the exchange rate moves to 109.50, which means USD yen, dollar yen move 50 pips. 50 pips, okay? That's because the number from the second decimal place has moved from 00 to 50, which is 50 pips. You have made a profit of $5, okay? Because that's a 10-cent change. That 0.01 reflects 10 cents. That 50 times that 0.10 equals $5. Simple. That is how to break down micro lot. And this also applies to a mini lot and a standard lot. So please take time in understanding this slide. So the next thing that I'll discuss is leverage, moving away from lot sizes. Leverage is a very important tool that we all use whilst trading. Leverage allows us to basically trade more than what our account value is, which is a good and bad thing. Again, this is to teach us what is required of us as traders. And again, tell you the truth. Leverage is a good thing if used correctly, but over leveraging yourself can be a problem. Okay. Handset Markets allows clients to select their own leverage. Our max leverage is 500 to 1. I know that there are brokers out there that do over 500 to 1. I personally would not use them because that is too high leverage, too much risk. But leverage is the ratio of the amount used in a transaction to require deposit. So what that means is that if you put down 1, Handset Markets will leverage you up to 500. So your 1 is equal to 500. Leverage allows traders to execute trades far higher than the capital they have. For example, leverage of 200 to 1 means you can trade a value 200 times greater than the capital in your account. Simple. That is all leverage is. Leverage is like assisting you so that you can basically trade the way banks or big institutions do. Because they have huge funds and capital, they're able to leverage one-to-one. They can actually do the trades. But me, I'm a small trader. I'm a retail trader. I do not have that same access to liquidity or funds. So I then speak to the broker, or I register with a broker who then gives me leverage. And that leverage is then equivalent to my trading. Okay, so that is leverage. The next thing that we'll discuss is equity. Again, when you become a trader or when you're trading, this is something that you'll take note of every day whilst you're trading. Very simple. Equity refers to your balance plus or minus your open positions. Your balance plus or minus your open positions. But if you have no open positions, your equity is the same as your balance. I feel like the example below is a perfect example to describe what equity is. Here you see in the first example that my balance is $500. I have an open profit and loss, so I'm losing $150. That means my equity is now $350 because why? My open position is down $150. My balance is $500. If I'm to close that position, I would have taken a $150 hit, leaving my equity and then my balance at $350. But it's because I have an open position. That is why my equity is not the same as my balance. Next example, you see that I have my balance 500, but I have an open P&L, an open profit of $100. That means my total equity is $600, okay? $600. So if I'm to close that position right now, my equity will match my balance and my balance will also reflect 600 and my equity will be 600. When there are no positions, so my balance is 500, my open P&L, no open positions. So I'm not losing, I'm not gaining, no open positions. My equity remains at 500 because I have no open positions. The moment you open a position, your equity will change. Your balance will remain the same until the position is closed. But your equity will then change as soon as that open position, because you'll be plus or minus as soon as that position starts going. Margin, another term that you hear very frequently, okay? What is margin? When trading Forex, you are required to put a small amount of capital to open and maintain a new position. This capital is not taken by the broker. It is just used for you to open the position. Once the position is closed, that margin is then returned back to your account. It's never taken away. It's just held as a somewhat, let's just say, security deposit for your position. Free margin is the amount of money in a trading account that is available for trading after you have opened a position. So that is equity minus your used margin. Again, I know this might be a little bit confusing, but this is why we are here. And these examples give us perfect understanding as to what it is. So right now, we're really going to look into free margin. Example 1 shows me that my balance is $500. I have a position open, and that position took $50 margin, okay? I have an open position where I am gaining $100. My total equity is 600. That is the 100 plus the 500. The free margin that I have, which will allow me to open more position, is 550. What that is that the $50 margin that I've taken to open that position minus my equity. So use margin minus equity. Simple. 50 minus 550 has left me with 50 minus 600, sorry, has left me with 550. Simple. The second example is balance equals $500. Margin, same, 50. But I have open P&L, I am losing $150, okay? My equity is $350. The free margin that I have is only $300. Why? It's because if I take away my equity and margins of 350 minus 50, that equals 300. I have $300 available for opening new positions. Not all currency pairs or instruments have the same margin. We also have a margin calculator on our website, which you can use. Additionally, we also have a breakdown of all margins on the websites as well. So if there's more information that you need about margin, please do not hesitate to visit our website or just call and contact your account manager. They'll be in the best position to help you. And the last slide just goes through some terminologies that you should know, which are general. General in the sense that you should know these. There's no in-depth analysis on them. You have long, which is placing a buy order on your platform. So anytime you hear long, the market is long, or I'm going long, that means I'm buying in the market. Short is placing a sell. So if I'm shorting the market, if I'm going to go short, that means I'm placing a sell order or sell trade on my trading platform. Flat means no position in the market at all. So I'm flat, no position, no trading activity, we are flat. Entry, the point which you buy or sell. So when you enter the market, that is your entry. If you place a buy, that is your entry. If you place a sell, that is your entry. That is your entry price, entry point into the market. TP, you'll hear this one a lot. I hope all of us will be hitting our TPs. TP is goal for the trade. That is your take profit, okay? That is the goal that you set. It's an order. When you place a trade, you set a take profit. It can be 10 pips away, 100 pips, 50 pips. It depends on where you feel the market is going. You place the take profits and the market will close there if the market hits that take profit. So if you have a 100 pip range, the moment the market has gone 100 pips, the market will execute and close that trade for you, and your profit will be locked into your trading account. You then have stop loss, SL, which is the opposite of take profit. This is used to protect you from catastrophic loss. So let's say I place a buy order and I put my SL at, or my stop loss, 50 pips in the opposite direction. So that means if the market is falling 50 pips away from where I've entered in my buy trade, because I believe the market is going up, but the market in fact goes down and it hits my SL, it hits my stop loss, my trade will automatically close. Okay, it's to protect you from going into deep loss. You can change your stop loss and your take profit once the trade is open. It's really down to you. It's down to what you're ready to risk, what you're ready to make. All these things will teach you in the more hands-on approach. So that is it for us here at Handset Markets and Trading Terminologies. I hope you've taken some good advice from us. Please, like I mentioned, we have access to the website. We have access to your account manager. If there's anything else that you feel that you could not get from here, send an email to info@hmarket.com and we'll be more than happy to assist you. Other than that, we hope you enjoyed this training session. Thank you very much for your time. Bye for now.